Hello, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Today in the interview series, I'm lucky to be joined by Eric Basmajian, the founder of EPB Research. Eric specializes in business cycle analysis. He's steeped in financial history. He's studied all the financial crises going back to the tulip bubble in 1636, and his work is often cited by legendary economists like Lacey Hunt. Eric, it's great to speak with you today.
It's great to be with you too. Thanks for having me on.
Yeah. Well, first, I think it's just a fascinating time to be trying to analyze the return of a more normal economic cycle. And you've got a way that you try to categorize all the different indicators. I thought it'd be best to start with just a summary of how you try to bucket things into different areas like leading indicators, coincident or cyclical, and lagging.
Yeah, so that's probably a good place to start. As you mentioned, what I do is I focus on business cycles, and we often hear that history rhymes or business cycles rhyme. They don't always repeat exactly, but they do have this sort of predictable rhythm that carries from cycle to cycle. And that rhythm is really generated by what I call the business cycle sequence. If you go back to all the business cycles that we have good economic data for, they all follow the same exact sequence for the most part, in terms of there are things that happen first, second, third, and fourth. What's different from cycle to cycle, and what gives each cycle its uniqueness, is that the leads and lags between step one and step two, or step two and step three, are different, and I would say unpredictable. So if you look back across all economic cycles, the time delay between, let's say, a contraction in step two and a contraction in step three could be anywhere from 4 months to 10 months, let's say. And that is useful and helpful, but it's really important for people who are trying to use business cycles in their investment process to really embrace what that means, because when we look at it on paper, 4 months to 10 months with an average of six sounds pretty straightforward. But as we're realizing now, when we live through these periods, that range of outcomes, let's say from 4 months to 10 months, that 6 month period is longer than most investors' time horizons. Most people want things to play out in 1 month or 2 months. And if we're following a business cycle process, we really have to embrace some of the unmodelability of these leads and lags from step to step. So what I do is I try and break the economy, or I try and bucket economic data into several of these steps. And by bucketing them into groups, it's helpful because while there are many good economic indicators, none of them are infallible. Any indicator that you pick is subject to fail at least once. But let's say you take 10 indicators that all have an 85% or a 90% success rate, and you group them all together, the chances of the basket failing is much less likely than any individual indicator. And it also helps separate some signal versus noise. Are 1 out of 10 indicators showing a contraction, or are 8 out of 10 indicators showing a contraction? That's really a big difference. So I like to use 4 buckets. You can use 5. You could use as many as you want. But I think it's helpful for people to think about economic data in roughly 3 or 4 buckets. So I track what I call, and what most people call, leading economic indicators. Those are things that generally move first. I'll review all of the buckets, but just to go through them, we have our leading economic indicators. The second grouping that I follow are what are called the cyclical economy. Then we look at the aggregate economy, and then we have our lagging or non-cyclical economy. So whenever economic data comes out, a lot of times we'll see maybe retail sales, building permits, and industrial production, all reported in the same week. But these things fall completely on different parts of the sequence. So when an economic data point comes in, it's very important to sort of bucket it where it's supposed to go, then see how it's performing. And when you fit it into the whole story or the whole sequence, it makes a lot more sense. So just to review those buckets, at the risk of ranting too much here, when we're thinking about our leading economic indicators, we're really thinking about the availability of money and credit, and the parts of the economy that are instantaneously affected by changes in the availability of money and credit. So you can think about any of your monetary aggregates, your yield curve, and then your soft commitments that can be changed really at the snap of a finger, like a building permit or maybe a new order. It's a loose commitment because you can cancel it a couple weeks later and it's not very binding. So those things tend to change very quickly when changes in the availability of money and credit change. The second step, or that second bucket, is the cyclical economy. And those are the parts of the economy that are very interest rate sensitive or very credit sensitive, which is why they react first after those leading variables change. And in this bucket, we're mainly focused on the residential construction sector and the manufacturing sector. A lot of people bucket construction as a big, broad bucket. We have non-residential and residential. It's very important to recognize that only the residential construction is what fits into this cyclical bucket. Our non-residential construction, which is a very popular talking point right now, really is that non-cyclical or lagging bucket, because some of these contracts can take 3 or 4 or 5 years to play out. So once the leading indicators move, then the cyclical economy of residential construction and manufacturing moves. Then you start to see the changes in what I would call the broad or aggregate economy. That's the metrics that most people follow: your employment, the things that the Federal Reserve looks at, job numbers, wages, things like this. And then after you see it in the broad statistics is when you'll see it in the most lagging parts of the economy, like that non-residential construction and parts of your service sector that are very, very non-cyclical, your healthcare, education, government, things like this. So my overall process is to follow this sequence of leading to cyclical, to aggregate, to non-cyclical, and see how the progression of those various parts of the economy are moving. Because if you have a strong change in step 1 and step 2, you can be quite sure that there will be a change in step 3. We can do our best to try and gauge the time range in which those changes will occur, but we can be quite certain that those changes will eventually happen.
That's a great summary, and I think it's helpful to have that framework in place, especially since this economic cycle has been more slowly developing, or a little bit more like past cycles in history, rather than what happened so quickly during the pandemic. What I wanted to just see next was, where does these different indicators or these different buckets, where do they stand today? Because it seems like the leading indicators are pretty solidly negative, and your cyclical indicators are still growing slightly, but are below their normal trend. And so what are you looking at from here in terms of, if there's going to be a continuation of a slowdown, what's most important to watch between these different buckets?
Right. So you're spot on. So we've seen the leading economy, or those leading indicators, move into categorically a very deep contraction as early as the summer of 2022. And when those leading indicators contract at the rates that they started to contract in the middle of last year, that's when you have to put up your recessionary flags, because there are certain cycles that do move rather quickly, and we don't really know what those leads and lags will be. They're very difficult, I would say impossible to model. So we saw recessionary contractions in the leading economy as early as the summer of 2022, and those leading indicators have really only gotten worse from there. We're now seeing broad baskets of leading indicators contracting at levels that usually are seen in the middle or even at the end of some of these recessions. So very broad, very deep contractions across the leading economy. That tells us that the residential construction and manufacturing sectors should start to see contraction. As you mentioned, we're not seeing broad-based contractions yet in the cyclical economy. And this time delay, what's been about a year between the leading economy moving into contraction and our residential construction and manufacturing sectors sort of teetering on the edge, that gap right there is really the biggest challenge of this COVID cycle. It's been a very long lag by historical standards, this basically 12-month period between leading and cyclical. But if we dive into that cyclical, what we see is that industrial production, which would be one of our major proxies for the manufacturing sector, has been contracting since September of 2022. Roughly on schedule, the contraction has been somewhat mild. You're also starting to see the very early signs of manufacturing job losses in some of the last labor reports. So that, again, does make some sense. What's really been the standout that's holding this cyclical economy up is the residential construction sector. And here we're really talking about the construction of single family and multifamily or apartment buildings. It's really been the apartment construction that has yet to slow down at all, despite the fact that interest rates have gone up and the leading indicators are telling us that you will see a slowdown there. So I'm really focused on this cyclical economy because unless that part of the economy contracts sharply, it is very difficult for the broader economy to move into recession, since that cyclical economy is really what I would call the engine of the economy. So the cyclical economy has slowed dramatically. It was growing at something like 10, 12% growth rates in the beginning of 2022. It's slowed to basically stall speed, about 0%, 1%, somewhere in this range, but it hasn't yet moved deep into contraction as we should expect based on the leading indicators. When we go to that aggregate economy, our unemployment rate, the big things that most people look at, we see a similar story as that cyclical economy, which is that we've slowed very dramatically or slowed down very dramatically from some of these artificial stimulus induced levels coming out of COVID. We saw 10, 12% real growth rates in some of these coincident indicators. Those have now slowed to the low 1% range. So we have this very difficult position for business cycle analysts and investors where leading indicators are deeply recessionary, but that cyclical economy and aggregate economy have slowed to basically 0 or 1% growth, but they haven't yet sort of had this flush or plunge below zero as is expected. This is what we would call the imminent recession or slowdown phase, where you have contracting leading indicators and sub-trend coincident indicators. And frustratingly enough, we've been in this exact setup basically since Q4 of last year. We remain in that setup today. So my prognosis or my forecast going forward is that we still will experience the recession that's been forecasted by these leading indicators. It just may be started maybe in the middle of this year, Q3, Q4. It's possible it even moves to Q1 of next year. Like I said, these leads and lags are very difficult to predict. But what I will say is that when we follow the trajectory of these indicators, they're moving roughly according to historical paths. I mean, sometimes a little longer, sometimes a little shorter, but nothing is moving totally out of the norm, which would suggest to me that the process or the sequence is broken and will avoid recession despite the contractions that we're seeing. So I still hold the view that the economy is in this imminent recessionary phase and will likely experience the full recession in due time.
You've got a great chart on that imminent recession phase, which we'll put up, and it definitely has a strong track record. I think there's only been one false signal in the mid-1990s, which is the one everyone cites, that the economy could recover on its own. But pretty much preceding every single recession, even going back to the 1960s, we've had this stretch where the leading indicators were very negative, while the coincident economic growth was very slightly growing, but below trend. So it's a good point there. And one other chart that you have that speaks to this point that it can take a while for this all to develop. I like the way that you pointed out when you have an inversion in the yield curve between the 3-month Treasury yield and the 10-year Treasury yield. When the 3-month yield moves higher, that tends to signal that there's going to be economic weakness ahead. But this takes time. And you've got a couple of good charts where you show that when you have that inversion, which happened here in the United States towards the end of last year, the leading economic indicators basically just start going straight down and remain declining for more than a year. But it can take about 12 months for the coincident economic growth. It'll keep growing for about a year after that inversion. And then you finally see it kick in on the aggregate numbers. And we're heading towards that stage where it'll have been nearly 12 months since that inversion. And this would just be right in line with that.
Exactly. Those are these long and variable lags that we hear everybody talk about. Yeah, that chart that you mentioned is one of my favorite charts at the moment. And again, what's made this cycle difficult is that the leading indicators are falling faster and more strongly than average after the yield curve inverts. So after the yield curve inverts, leading indicators follow an average trajectory where they pretty much go straight down, as you mentioned. We're going down faster than normal on the leading indicators, which has to give you the bias that the coincident indicators will also fall faster than their average track. So it takes on average 12 to 13 months for those coincident indicators to peak and then contract very sharply. It's possible that the leading indicators fall faster and the coincident indicators take their average path, which would put the start of the recession somewhere around Q4 or Q1. But I've been on the earlier side of this because I'm taking my cue from the leading indicators, which are falling faster than normal. So I still tend to believe that the risk is that people are blindsided by how quickly or abruptly the slowdown may come. It's possible that it doesn't, but if you can see on the chart, the coincident indicators, while they're following their normal trajectory, they're underperforming what they normally do. So the growth rate is slowing down, which I think, again, is a potential sign that we may not make it to that average trajectory. It's possible. We have to embrace some of this uncertainty here, but that's the way that I'm looking at it.
Yeah, it's a good point. I want to switch over. You mentioned that residential construction was one of the cyclical areas that we're still seeing some strength. And it surprises us, too, to see just how much activity there is in multifamily buildings. So many apartment buildings still being under construction, which seems like it's going to lead to a significant oversupply in certain regions of the U.S. But I just wanted some of your most popular videos on your YouTube channel have been focused on the housing market over the past year. And it's been a few months since you've provided a more mainstream update on that. The last two things I remember in the last video that really stuck out to me, one was that we were 6 months into a decline in real home prices adjusted for inflation. And usually when you go into a downturn like that, it takes on average about 3 years for that to play out before home prices really start growing again faster than inflation. And the second point you made was that for the top 20 metro areas, 3/4 of them were showing these declines in home prices. So I'm curious, I know since then there's been some month over month increases in home prices, but what's your take overall on where we're headed in the intermediate term in the housing market?
Sure. So I'll give a couple of upfront caveats that I like to do when I speak about the housing market, which is that we have to separate a few different things when we're talking about the housing market. One is the volume of transactions. The volume of transactions is or leans more towards a leading economic indicator. Then we have our actual construction activity, which is building the homes. And then we have our home prices. Home prices are a lagging economic indicator. So discussions around the housing market can get very confusing because the volume of housing transactions can collapse quite early. like 2006 in that example, but the home prices don't have their largest decline usually until after the recession is over. So there can be a 2 or 3 year gap between when the volume of housing transactions falls and when home prices fall. So in 2022, we saw a very significant, I would call it a collapse in the volume of transactions, 30, 40% decline in the volume of activity. That is a leading economic indicator, and that makes a lot of sense. We've seen home prices start to soften and they started to roll off their peak. Now, housing, as we know, is very regional. And what we're seeing now is that the breadth of the declines in home prices has compressed a little bit. It was about 75% of the country was seeing home prices come off. It's come down to about 30 or 40%, where most of the declines are concentrated in San Francisco, Seattle, Portland, a little bit in parts of Colorado, Vegas, Phoenix, places that either have, I would say, demographic or maybe political headwinds, and then places that have a significant volume of new construction. Because the biggest bifurcation that we're seeing in the housing market today is the difference between existing home prices and new home prices. About 85 to 90% of people, when they buy homes, they're buying existing homes, homes that have had a previous owner. About 10 to 15% of people buy new homes directly from a home building company or a new construction. The supply of new homes or new construction is actually quite high. It's been above the, in housing terms, people like to define the months of supply. And when the months of supply is greater than 6, that tends to mean that there's plentiful supply and there will be downward price pressure. When the month supply is below 6, that tends to be a pretty tight market with upward price pressure. At the moment, we're seeing a month supply of new homes near 8, which is putting downward price pressure on the new home market. We're seeing new homes in nominal terms are down about 18% from their peak. So we've seen a very big drop in new homes because home builders have some inventory. They're using incentives and buy downs and discounts to try and move that inventory. And we are seeing a decline in home prices for the new home category. For the existing home category, which is where most people play, the month supply is still down at 3, which is very, very low, which is preventing the prices from sort of gapping down to where that new home market is. But what I would say is that historically, the new home market tends to move a little faster because home builders are like any other industry, and they always have to drive volume. They can't sit on these homes forever. So you do tend to find the clearing price faster in the new home market. But right now, where I see the housing market is that home prices will decline. We have leading indicators of home prices, which are clearly showing us that there will be a softening of home prices. At the moment, all of the declines in prices that we're seeing are concentrated in the new home market and very select regions of the country, like on the West Coast and some of these areas with plentiful building. So we've seen the market tighten up a little bit over the past couple of months. It's sort of been in conjunction with the equity market getting more enthusiastic. But my view is that we will continue to see downward price pressure for new homes. And as the labor market softens, you'll get the lagged effect of home prices declining most substantially after the labor market really shakes up. So it's really important for people to remember that home prices lag the business cycle. We're going to see a shift in the unemployment rate first. Then we'll see the most significant change in home prices. So my view on that is still very much the same.
Yeah, it's a great update. I think you're right. It's not that this housing market has to play out similarly to the housing bubble with the great financial crisis. But it is interesting that in 2005, housing prices peaked. And then to your point, in 2006, after declining a bit, home prices kind of stayed flat for a year. And then
They
the
went
real
back up a
decline
little
in
bit.
prices came
That's
from
right.
there.
Yeah,
Yeah.
exactly.
Yeah. Uh, with the time left, I just wanted to focus on the labor market, which is one of the big buckets or categories that has stayed strong on the aggregate level and showing some growth. But your leading indicators of the labor market are showing weakness and have actually turned negative. And we like some of the charts you put together, just using that ratio of looking at the leading employment indicators versus the real time or the monthly payroll numbers. And it seems like whenever you see this start of a weakness like we have in recent months, that's a precursor to a recession. I was curious what those leading indicators are that are showing weakness and what we should be tracking to see if there's any further cracks in the jobs market.
Yeah. So what's interesting is while the analysis that I gave about the broad economy, that the leading indicators are contracting faster than normal and the coincident indicators are underperforming, it doesn't hold perfectly true to the labor market. The labor market is following an extremely average path after the yield curve, a frustratingly average path. We're seeing a decline in leading indicators. We're starting to see the softening of the total jobs numbers from the categories that we would expect: the manufacturing, the trucking, the temporary help services. But it's taking the very average progression, which can be quite slow moving. So leading indicators of employment, things like weekly hours, those are falling pretty sharply, which is indicative that companies are feeling a margin squeeze. But rather than taking the more permanent or friction-filled binding step of laying people off, they're trying to reduce the hours worked of their employees to protect margins. At the same time that they're reducing hours worked, we've seen a very, very substantial decline in temporary help workers. We've seen about a 5% decline in temporary help workers, which is clear-cut recessionary when you look back over time. So the combination of employers or companies feeling a margin squeeze, laying off temporary workers and reducing the hours and overtime hours of their full-time staff, as we talk about this economic sequence, that is the perfect logical sequence that the employment market always follows. You see margins compress, then you see them trying to take the least binding steps that they can to protect margins. They'll lay off temp workers, they'll reduce hours. Then you'll start to see it'll leak into initial jobless claims. That's the very traditional sequence, and that is playing out. And then you start to see the job losses, but the job losses really only come in the economy's most cyclical sectors. So when the jobs report comes in every month, most people react to the headline number. You know, we all analyze the report within 5 seconds of it coming out, but there are thousands of subcategories and indexes to these reports that are really where all of the information lies. And I like to break out what different baskets of employment, what I call very cyclical jobs, non-cyclical jobs. And I really like to focus on that category of very cyclical jobs, which would include your temporary help workers, your trucking and transportation workers, manufacturing, residential construction. Those categories make up about 21 million payrolls, about 13% of the total workforce. But much to everyone's surprise, despite it being a very small category, only 13%, and you can fact check me on this, nearly 100% of the recessionary job losses will come from that 13% category, which is why it's very, very important to stay laser focused on that and not be confused by some of the really lagging parts of the economy, like government, education, health services, and other parts of the services sector that can be adding jobs for 3, 4, 5, even 8 or 9 months into a recession. And when we look at those very cyclical jobs, we've seen job losses for about 7 months in a row. for that very cyclical category. Now, they're quite mild. We're not seeing massive job losses, but we are seeing a very consistent string of job losses in the most cyclical parts of the economy after we saw a contraction in the leading employment indicators. So that's a very strong confirmatory signal, in my view, that the labor market is weakening. It will continue to weaken, and it will take a couple more quarters of this for it to show up more forcefully in the broad national statistics that everyone sees. But there's nothing that I'm seeing from this employment sequence that would tell me that by this time next year, we won't have already gone through a decent rise in the unemployment rate.
Yeah, it's a great point about the very cyclical industries. I remember I was surprised when I read your report about that even though it's less than 15% of the total jobs, it still drives much of the employment losses when you do go through a stretch of economic weakness. So it's good to know that we still need to keep an eye out for that.
Yeah, it's exactly. I put a chart out. It wasn't in any of these recent reports, but construction and manufacturing are about 20 million payrolls. And outside of the COVID recession, which we have to exclude for a bunch of obvious reasons, there has never been a recession. There has never been a recession where construction and manufacturing hasn't lost more jobs than the services sector. So even though these can feel like categories that are dwindling in their importance, the amplitudes or the boom busts that are experienced in the manufacturing and construction sectors still outweigh all of the service sector jobs and sales and other categories, because that service sector is so non-volatile that even if you take a small category and you have a huge amplitude, it really does power the ups and downs of the full business cycle, which is why I spend so much time focusing there and trying to call out when we see a big shift there, because it always precedes changes in the broader economy.
Yeah, we'll definitely keep an eye on that. Well, Eric, this has been terrific. I'm really glad we could get an update from you on the economy, the housing market, and the labor market. If people want to follow you more closely and learn more about your work, where should they look?
Yeah, thank you so much for having me on. This was great. People can go to epbresearch.com. That's where all of my descriptors and services are listed. You can always just reach out to me on the website by using the contact page if you'd like to see any of these reports that we were discussing. And then I'm also very active on Twitter and a little bit less so on YouTube, but you can find a lot of my work there as well. And again, just feel free to reach out to me on Twitter or via the contact page. More than happy to get in touch and see how I may be able to help.
We have a lot of business owners that watch our videos as well. I believe you have some research services specific to business owners too, don't you?
Yeah, thank you. That's a really great chance for me to explain that this is not just for asset managers. A significant portion of my client base is business owners, specifically in these cyclical industries, because as they know more than anyone else, there can be some very significant ups and downs in the cyclical economy. And having a process like this, or knowing which indicators to look for to give you a heads up of what's coming, can be valuable for a lot of business owners. So what I do when consulting with these business owners is I understand their business and then inform them where along the sequence that their business fits. Because if you're a non-cyclical industry, the indicators that you are going to want to look for will be different than someone who's on the leading side of the economy. If you're a lagging industry and you're looking at leading indicators, you may be 2 or 3 years too early. So what I like to do with the businesses that I consult with is understand where their business fits in the economic sequence, and then provide them with some updates and tools and indicators that are most helpful for them to give them an idea of when they should be seeing changes in their business with a more timely sort of range. So thank you for allowing me to explain that.
Yeah, definitely. I just know it's been very useful for us to follow your work in recent years, and look forward to following in the future. Thanks again for being on the show.
Thanks so much.
All right, take care. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.